Well, thank you, everyone. Thank you for your questions. Apologise, couldn't get through everybody's questions, but it's great that you are asking them, and we will try and do as much as we can through the course of the day to accommodate those interests. It is now my pleasure for me to sign off and hand across to Sebastian Gericke, who is in situ in Dunedin in the physical component of our meeting, and I'll hand over to you, Seb, for the next session.
Thank you, Craig. Welcome, everyone. So the next session we have relates quite nicely to some of the things that have been mentioned. One of the things Grant mentioned was the affordable housing crisis that we are facing in New Zealand, or the housing crisis in general. And so building housing has become one of the sort of key approaches in New Zealand impact investing, or I'd say it's one of the lowest hanging fruit. So that ties in quite nicely to our next session titled Green Real Estate and Development. And as our first speaker, we have Sean Kidney, the co-founder and CEO of the Climate Bonds Initiative, which does green bond certification and definitions. He has overseen a vast number of global issuances, and he is also a member of the EU Commission Platform for Sustainable Finance, which I think is leading the way in sustainable finance regulations and policies, and we can learn a lot from them. So thank you for your great work, Sean, and thank you for being here and talking to us.
Thanks for having me. Very exciting. I always have a special spot of closeness of University of Otago-based events, because I've got a sister who lives in Dunedin and a sister who lives in Queenstown, so there's a kind of coming home. But I appreciate the audience is bigger than that. Look, the reason I'm talking is because the green bond market has gone bananas. In the last 10 years, from a market of about $1 billion US outstanding when we got going, we about now have achieved the global green and sustainable bonds market of US $2.5 trillion outstanding. And it's growing 80% this year, and we expect it to grow commensurately next year as well. So this is a large market. It's a large market. These are investments that go towards addressing climate change in one form or another. I mean, these are bonds. They're not equity investments or lending by a development bank, although those sorts of investments can go into being part of a bond. Now, a bond is just a debt, and it can be buying a new car or a used car if it's electric. It's a bit like you go to your aunt, decide to borrow money to buy a car, and your aunt says, "That'd be nice, dear, and I trust you to pay me back, but I want to make sure it's electric because we need to shift the way we're working in the world." And you say, "Yes, of course I want to get an electric car. What's more, I'm going to come back every year and take you for a drive at Christmas to show you how well it works," assuming the drive is in Queenstown and you live in Christchurch, and you're not there every weekend. So that's the kind of idea. It's as simple as that, really. It's a piece of debt where you are allocating the proceeds of the debt to addressing climate solutions of one sort or another. A new solar farm or a solar farm was built 4 years ago will qualify. Bonds are primarily a refinancing tool. Now, I say that because some people are saying, bonds can only count if they are for the new investment. That's equity, that's bank lending. By allowing refinancing in the bond market to pension funds and insurance funds mainly, who typically don't buy project stuff. It's too complicated for them. They want someone else to develop it or to manage the financing of it. And then when it's in place, earning a nice recurring income to ensure they can pay your pension when you retire in a few years' time, then they're interested. By making refinancing easier and more attractive, we spur development of equity and bank lending. We recycle funds faster and so on. There's a whole story about why. But this idea of the green bond has also done a couple of other things, apart from create a preferential market in its own right. It's changed the terms of discussion about green investments. So when we started 10 years ago, or more than 10 years ago now, people were saying burden, cost. This is a kind of negative effect of the Stern report, if you like, because one of the things that stuck in people's minds all those years ago was the idea it would cost 1 or 2% more. Hey, it doesn't seem like a lot, right? But it was still a cost paradigm. And investors who are bound by fiduciary duty to invest, to pay pensions and meet assets and liabilities were worried, while they were concerned about their 20 and 30-year horizon, their ability to match assets and liabilities when you finally retire. They are using portfolio management techniques that typically have only got a 5-year horizon, and then it was hard to quantify the benefit of green bonds and so on and so on. So with this green bond, we came up with this idea, which after a few years of fighting for the establishment of it, became entrenched as a similar risk and yield instrument, which had a bonus feature where the identification of the use of proceeds involved going to something that addressed climate change. That bonus feature is what making a bonus feature is allowed to grow dramatically to this now very large market globally, with extra benefits beginning to appear, as we always predicted would, once we had liquidity and price discovery in the secondary market. There are some interesting things that have appeared in the green bond market. In downturns, and the rest of the bond market goes whoosh, they hold their value. Last year in March, when the bond markets froze globally for a couple of weeks, green bonds stayed liquid. That is, if you're a pension fund or insurance fund and you're defensive in nature of your investments, these instruments could still be cashed in to pay out a pension when all the other bonds could be gold dust. As a result of these increasingly beneficial secondary market characteristics, we've now got a primary price depression. That is, you get a low interest rate if you issue a green bond. For a AAA issuer like the European Union or Germany, who've done sovereign green bonds, the German sovereign green bond is a negative interest rate bond. What a world we live in. You pay them to look after your money. Well, they got an extra 2 basis points reduced interest rate because it was green. In the secondary market, it's tracking at 5 basis points benefit. Now, this may not seem like a lot of money to you, and it isn't if you're borrowing money from your aunt to buy a car. But if you're the UK government and you borrowed 10 billion sterling recently of a green bond, that saves you 28 million pounds over the life of the bond, of a 7-year bond. So this is becoming substantial. And this is consistent amongst liquid economies. Well, actually, not only liquid currencies, not only liquid currencies, because the Egyptian green bond, which was a sovereign green bond, is tracking in the secondary market at a 75 basis points premium. That is a better interest rate than the ordinary vanilla Egyptian sovereign. In Moscow, I was on a panel recently to Deputy Mayor of Moscow, and he said to me that their inaugural green bond, quite a lot of energy efficiency in buildings in that portfolio, got a 20 basis points lower interest rate than their vanilla bond in Moscow with rubles, where there had been no green bonds. This is a bit of a global story now. That's why I'm here today, or at least I think that's why the organisers have invited me. Of course, behind this is a whole story of risk. For investors, we have the palpable and real risk of impact on their portfolios over the longer term of the effect of climate change. As you probably know, emissions went down last year by 8%, bounced back up already globally, 16% this year. We're back on track to the worst possible outcome of climate change predictions. We expect to see the Arctic being ice-free in a couple of years in summer. We expect to see all sorts of things happening much faster than we had expected. We already see climate change, well, this year, fires, floods, and even the pandemic, which is as a result of pathogens jumping between species, shifted around because the collapse of biodiversity, deforestation, and climate-induced collapse of natural environment. We have a live experience over the last 2 years, a year and a half, of a surprising non-physical climate change impact of the kinds of changes we are wreaking on the global environment. This, by the way, is not unexpected. The Intergovernmental Panel on Climate Change has been predicting that pandemics will become a feature of climate change. They've been predicting this for the last 30 years on regular reports. We've had a couple of close calls already in the last 20 years. This one got away from us. I hate to say it for my friends in places like the US, Brazil, India who have lost loved ones, but we were lucky at this pandemic. 1% mortality rate, it affected old fellows like me. The SARS virus, if it had got out of the gate, had a 20% mortality rate and affected primarily 30 to 40-year-olds. That really would have wrecked the global economy, global society. Let's face the fabric of our lives and our families around the world. We can expect more of these. We kind of need to prepare. And one of the themes I want to leave you today is the need to be thinking about resilience. Because the truth is, with the increased emissions we have continued to have over the last 30 years. In fact, if you didn't know this, we put more emissions in the atmosphere in the last 30 years than in the previous 150 years. With those increased emissions, we have consigned ourselves now to a world of volatility. There is no doubt that the 21st century in terms of weather systems will be much more volatile than what the 20th century was like. In fact, what the last few thousand years was like is what we think. We will see wild storms. We will see snow in Auckland in the middle of summer. All of these things. We will see sea level rises, of course, floods, fires. We will see large parts of the world become uninhabitable. Well, at least uninhabitable without going underground and air conditioning on permanently. I've been saying to my colleagues when I gave a presentation to the financial regulators of the United Arab Emirates recently, they need to be starting to plan in the 2050s for consecutive days and weeks of 60 degrees Celsius temperatures. That needs to mean a very difficult physical environment. These are city-states, urban islands in a desert. The Burj, a tower of glass, will not survive very well in that kind of extreme extended heat. They need to be thinking of putting their shopping malls underground to look at thermal insulation. They need to change the quality of the materials they use now because heat stress changes things dramatically. If you don't plan ahead, you get what happened in Victoria and Australia about 5 years ago. Consecutive 50 degrees Celsius days, the train lines buckled. The steel wasn't to the right tensile strength. All of those train lines now to be relayed, and hopefully, I believe the Victorian railway system near Melbourne is laying higher tensile strength steel that can cope with the higher temperatures that will now become the norm. This is all happening. It's underway. We're, however, still in a race to avoid catastrophic climate change. If you think, well, let me phrase it this way. If the IPCC's projection of, or rather prescription of a 55% cut in emissions by 2030 is not met, we have a very high likelihood, more than 50%, of seeing runaway climate change during the century, which means temperatures are somewhere between 4 to possibly 8 degrees Celsius on average. In places like the Arctic, it'll be an increase in temperatures of somewhere between 12 and 14 degrees Celsius. There will be no ice in Greenland by the time this is finished, which is sea level rise impact, of course. So not so good if you've got coastal property in Auckland. A little bit better if you've got something back at the hill in Wellington. These kinds of things are going to become the topic of this century. The solution. Well, oddly enough, we have all the solutions in front of us. The scientists tell us that we have a window to address anthropomorphic impacts on climate change, to get emissions down, basically, and to get emissions out of the air. Direct air capture will become a term you'll hear a lot about in the next few years as we start trying to look at how to drastically and quickly reduce greenhouse gases in the atmosphere while stopping their growth through stopping sorts of activities. We know what to do. It is a fairly high capex path. It's about a $90 trillion US capex path between now and 2050 to shift our economies onto a green, low carbon, climate resilient footing. Of course, the larger part of that isn't so much new, it's repurposing. If you're building water infrastructure, you now need to be thinking about adaptation, obviously, because rainfall is going to change, everyone. Floods and drought in between will be the norm rather than persistent gentle rain pretty well everywhere. You will need to be thinking about the reduced energy use of that water infrastructure. So that's repurposing of existing flows. but there will be a fair chunk of new, particularly in emerging markets. We are in the process of creating a string of pearls, we hope there'll be pearls, of cities with 20 million people scattered around the emerging market zones of the world. They need to be clean and green, otherwise we are stuffed. We are toast, because that's where emissions of the future will be, in India, in Africa, in Brazil, in Southeast Asia, in Jakarta, etc., etc., etc. I mean, if we invest this amount of money, well, on the other hand, this would be the biggest investment stimulus, Keynesian stimulus in the history of humanity. There have never been these levels of sustained investments except short periods during war, 3 or 4 years long in World War II, when the US started investing hugely. This would be an extraordinary impact if we can do it right in terms of its impact on economies, on societies in the world, even in just the energy space. The World Energy Outlook of the International Energy Agency that was published a couple of months ago shows with the investment just in energy, which is a small percentage of the total amount that we've got to do, we would see GDP growth significantly higher than an alternative, and more to the point, jobs growth significantly higher than the alternative. Of course, property. Why is this important? Well, 40% of the emissions reductions we have to achieve between now and 2050 come from the built environment. That's why it's important. Oh, there's another reason. 2/3 of hard assets on the planet are property assets. If we're going to look at capital flows and finance, we've got to get the property story right. It's critically important. If we're going to get beyond the $1 trillion a year of green bond issuance, which we expect to get by the end of next year, to the $5 trillion we should be doing to address our climate challenges, it's going to be heavily reliant on getting the built environment story sorted out. Now, what does that mean? Well, it does mean energy and emissions efficient buildings. Of course, there are some choices to be made. You know, in the last 10 years in tropical zones, we've installed more air conditioning capacity than we have renewable energy. That is a bit scary. We've got to stop this business of building glass towers in Port Moresby or Jakarta and whacking air conditioning units on the side of them. Incredibly inefficient. That requires us to bring forward some of the very interesting technologies that are coming to market with dramatically reduced energy use for cooling. It also requires us to look at the thermal properties of building in a way we haven't before. That Burj in Dubai and the glass, madness. We've got to have different kinds of structures. Well, matters of the glass they use. Maybe there's glass that has greater thermal properties. Don't care, just want someone to sort it, if you like. We need to set rules for these sort of things. We also, though, need to look at a few other things. The density of urban environments. We can no longer have sprawling cities, the Atlantas of the world. Atlanta, you may not know, has the same population as Barcelona. Barcelona has 1/8 the surface area of Atlanta. You know, Barcelona is not a bad place to live. Great cafes and tapas bars, a different kind of environment to live in. We can make choices about the cities we build now in a way that will have extraordinary impact as we grow, and this is especially the case in emerging markets. We need to be looking at infrastructure and how we finance infrastructure. For example, in Jakarta, which has 3 metro lines of a city, well, in fact, the second largest city in the world, 30 million people. If you go to Hong Kong, just up the road, you will see a fantastic example of how to finance what we need to do. MTR in Hong Kong, a separate entity, runs at a profit. 75% owned by the government, 25% listed on the stock exchange. It builds property over the stations and uses that to pay for the subway line. That could work in Jakarta. You know what? That could probably work in Auckland too. Let's have a think about that. Although we might need greater density, we need greater density. Yes, we will be living in towers with fabulous views and apartments. The quarter acre block is going to be much tougher to justify. We do need to be thinking within that city envelope of resilience, thermal heat, greening. As you know, putting trees down the street in the middle of Christchurch reduces the ambient temperature by 5 degrees Celsius in summer. Well, that's especially important in Jakarta, of course. We need to be allocating more territory to wilderness. One of the great horror stories unfolding in front of us around the world is the collapse of biodiversity. species after species disappearing in front of us, let alone the denuding of existing species, and therefore the taking them to the edge of collapse. Climate change and biodiversity collapse are not linear. They are going to be, and they are, very jagged and step changes. Biodiversity tends to happen in big lumps, big jumps. Something disappears, like the cod disappeared off the coast of Newfoundland 40 years ago. This is what we're going to see, the collapse of species around the world. We need to start working on this. One of the key things is to leave aside great swathes of the ocean and great swathes of the land for wilderness and repopulation managed environments where biodiversity can recover. We do know in the oceans that putting aside 15% of the seas for marine parks is enough to allow fish stocks to bounce back if you pick the right places. Well, imagine if we can start taking this to the open oceans around the South Pacific, etc. This is the agenda we've got to work on. Now, I say that because New Zealand is a maritime power in the sense that it has huge areas of the ocean in its 200-kilometre zone. It needs to have its voice loudly heard globally about how we manage the commons that we are currently depopulating with species. It needs to be looking at what we've done in the Antarctic with an agreement about how to manage the area and taking that to the rest of the commons that we have not yet addressed, particularly the oceans. All of these are part of the urban agenda because they will depend on densification of cities and, if you like, the constraining of humans so that we can create more open space around. And I'm going to apply that to agriculture too. I'm a big fan of urban-based agriculture. We saw in the pandemic the need to be able to source food locally in places like China and Europe because supply chains got cut at different times. Well, that's a reason for us to be thinking about urban farming, which is becoming viable. And by the way, becoming viable as an alternative to cattle farming too. Rather than expect everyone to stop eating meat, might be good for the environment, but it's going to be challenging with 7 billion people on the planet. We can shift to manufactured forms of protein quite quickly and quite easily. Urban farming will be something we'll see a lot more of in the next few years. So when I look at the property agenda, I'm not just looking at buildings. I'm saying it's part of it, but of course in buildings, we do have $250 billion outstanding of green property bonds around the world. We need to grow that. We've set criteria for what count as a green building in the Climate Bonds Initiative, in the European taxonomy, in various guidance we're bringing to market around the world as part of regulation. That is guiding the development of the market. Boundaries create those markets. Those things at the moment need to be expanded as we develop more data points around embodied carbon, the concrete and steel, the components of it. It will be expanded to different kind of instruments. We already have bonds, sovereign bonds with property involved, asset-backed securities, loans. We will see equities. We will see the assessment of real estate trusts who are committing to adequate ambition of improvement of the energy efficiency of their performance as a climate change asset going forward. We've had a fantastic start here. We've created a foundation in the green bond market. We now have to extend that into different instruments, into resilience and into social, as we heard earlier. Social housing that is also very energy efficient is already appearing in green bonds, but is part of the resilience agenda of all countries. I'm kind of hopeful because we do have proof of concept here. We know we can get the investors excited. Every single bond that comes out now is way oversubscribed if it's green. We know that governments are beginning to realize that they don't act on the green imperative, they will be penalised. The Australian government, Friday before last, put out a note to market. If they do not adopt the net zero market, they will suffer an interest rate penalty of 100 to 300 basis points because they'll have reduced access to funds. Dead right. New Zealand won't have that problem if we do it right. The revolution has started.
Sean.
I'll just finish up. The revolution has started. Change is coming. Property is a vast part of it. But now we've just got to make it happen. Apologies, go ahead.
Thank you
I'm
so
done
much
now.
for that, Sean. Very insightful. And to be honest, I could probably listen to you talk for a while longer, but we do have to let the other speakers have a chance too. I did want to get one quick question in from Connor from the New Zealand Super Fund, and he asks if you could talk briefly about the accreditation to ensure that the bonds you authenticate actually do what they say on the label. How does that happen?
So in New Zealand and Australia, most of the bonds get a climate bond certification. They've got to fit a rule set. They've got to get an independent review by a licensed verifier. His work gets reviewed to confirm that they meet the public rule set. And then they have to provide annual reporting that everything is still in order against what they promised in the tin. That works quite well. There are some markets where this doesn't work as well as it could. We're still working on that. For example, in Southeast Asia, we've got to do more work on promoting tougher rules, which we're working on with ASEAN central banks, but it's working pretty well so far. If you want to have a discussion or an argument, it's about what the rules are. And that we will continue to review on a regular basis. The rules get tougher and tougher over time. So a building that qualifies this year will not qualify in 2035. You've got to keep improving the efficiency of the envelope of portfolios. That's how that works. That's how certification works. In Europe, we're now making this part of regulation supervised by the regulators, as it already is in China. And I think we'll see more of that as we go forward.
Very good. That's under the Sustainable Finance Platform policies, I assume. Great. Thank you so much, Sean, for sharing your thoughts and time with us.